Buying another business isn't just handing over cash for assets. Under IFRS 3, it only counts as a business combination once you've actually gained control. So how do you know when that's happened, and what do you do about it once it has? In this lesson, I'll show you how IFRS 3 defines a business combination, and walk you through the 4-step acquisition method used to account for 1. Control, goodwill, all of it. Nadia's been running her 3 cafes for years, but she's ready to step back and retire. Rather than looking for a new partner, she offers to sell the whole chain outright, to our founder. This is different from before. Last time, the two of them set up a shared arrangement together. This time, one business is simply absorbing the other, completely. They agree on a price. Our founder will pay a lump sum, take over all of Nadia's cafe assets, and assume her existing supplier debts. The deal is set to close at the end of the month. The deal closes. Nadia's 3 cafes, her equipment, her staff, her supplier contracts, all of it now sits under our founder's control. Nadia has no more say in how they are run. From this point, in her own financial statements, this isn't a shared arrangement anymore, and it isn't a simple purchase of a few assets either. It's what IFRS 3 calls a business combination, and it comes with its own accounting rulebook. So what exactly makes this a business combination, and what happens next in the accounting? Let's break it down. IFRS 3 applies whenever an acquirer obtains control of a business. Not partial influence, not shared control, control. So what does that actually mean? Control actually has 3 parts: power over the business's key decisions, exposure to the ups and downs of its returns, and the ability to use that power to actually affect those returns. All 3 need to be present at the same time. In our story, once our founder owns all of Nadia's cafes outright, that's clear-cut, full ownership, full decision rights, full exposure to profits and losses. But control can exist even without owning every share, as long as all 3 conditions are met. Once control passes, IFRS 3's acquisition method kicks in, a 4-step process for putting the deal on the books. Step 1. Identify the acquirer. This is the party that gains control. Usually obvious, but in some deals it takes a closer look at who's really calling the shots. Step 2. Determine the acquisition date, the exact date control actually transfers. That's usually the closing date, and it's the date everything else in this process is measured from. In our story, that's the day the deal closes and Nadia hands over the keys. That single date is the anchor point for every number that follows. Step 3. Recognize and measure everything you acquired. The identifiable assets, the liabilities you're assuming, and any non-controlling interest, all at fair value, as of that acquisition date. Fair value, not book value. If Nadia's cafes were carrying an old oven at a low value on her books, it gets restated to what it's actually worth on the acquisition date. Once everything acquired is restated at fair value, you're left with one number: the fair value of the net identifiable assets, what was actually acquired, cleanly measured. Step 4. Work out goodwill. Take what you paid, at any non-controlling interest, and subtract the fair value of the net identifiable assets you just measured. If the number's positive, that's goodwill. You sit it on the balance sheet as an asset. If it comes out negative, that's a bargain purchase, and instead of an asset, you recognize it straight away as a gain. Back to our founder. She pays a lump sum for Nadia's cafes and assumes the supplier debts. The fair value of everything she's actually acquiring, ovens, fittings, contracts, net of those debts, comes out a bit lower than what she paid. That gap is goodwill. She's paying for more than just the machines and the fittings. She's paying for the loyal customers, Nadia's trained staff, and the reputation the cafes have already built. If this cleared things up, the full Brizo Console Academy course goes much deeper. Contingent consideration, step acquisitions, bargain purchase gains, and how Brizo Console handles the acquisition method automatically. Links in the description. And if you're consolidating real business combinations, not just cafe acquisitions, Brizo Console is built to handle exactly this: acquisition accounting, goodwill, NCI, and full multi-entity consolidation, all in one platform. Come see it at brizoconsole.com. Thanks for watching. See you in the next lesson.